presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for May the 9th, 2023. I'm Mo Ansari, President of Compak Asset Management, and we have a new media page. You can go to compak.com/media. You can subscribe to this bi-weekly update that I do on YouTube. Whenever I do an update, you will get notifications as long as you're subscribed to this channel. You can also listen to my daily podcast, a 1-hour broadcast that I do on a number of radio stations across the country. You can get that podcast absolutely free. To download mobile apps for the market wrap update, where you can listen to live, you can register for upcoming events. So a lot of information there. You can just go to compak.com/media. Looking at the agenda for today, I'm going to talk about the Fed. What did the Fed do or not do last week? Talk about the market a little bit, take a look at the economy, take a look at technical analysis and the week ahead. So let's start with the Fed. They raised interest rates to 5.25%, and now the forecast is that they are done. They're going to stop raising interest rates or hit a pause. We do get inflation data tomorrow on the 10th. The CPI data expected to be just about flat for April, slightly lower for the core when you strip out the volatile energy and food component out of it. And so we will see. If inflation does start to drop off, it has already dropped off, but it's still at 5%. So will it come down to the 2? It'll take time, but as long as it's not accelerating and it stays where it is, I think that'll give enough impetus for the Fed to stay where they are, where they don't make any changes to interest rates at the June meeting. And that will be, I think, overall positive for the market. But the market is in this sort of choppy period. I'll take a look at the charts a little bit later on. Expectation is that the Fed is going to start lowering interest rates, and rates are going to come down by the end of this year. I think the market is just being way too optimistic about interest rate decreases. I think the Fed will not raise rates, but they're not going to bring them down. Economy is still not going off the cliff. Unemployment rates are still at 50-year lows. So unless unemployment starts to go up, that means when that goes up, people stop spending, which is 2/3 of the U.S. economy. That is consumption. But consumption does not drop off until jobs start to disappear. They are starting to come down, the number of availability of jobs, but unemployment is still low. So I think this is a way too rosy picture of rates coming down unless we see the economy slow down dramatically. It can happen where the economy just goes off the cliff and the Fed has got to backpedal, start putting money back into the system. But right now, it's not that. The economy is sort of muddling along, sputtering along, not growing dramatically, but at the same time not slowing. Looking at the economy overall, you can see that this is the number of jobless claims. They have come up. So that is coming. And the number of job openings, you can see that they are starting to step down. Came down here, came down here, came down, came down. So number of job openings are coming down. At the same time, unemployment, the number of people applying for unemployment is starting to go up. So that is a slowing sign, and when jobless claims tend to trend higher, that means the economy could slow. Inflationary pressure, we talked about it last year when we said the rates we think inflation, when it was 9%, everybody was running around hair on fire. I said, I think we peaked, and we have. From there, we've seen inflation, the CPI, come straight down. Now the PPI, that's the producer price index, has sort of stayed where it is, come down, not as fast, and it takes a lot longer, I think, for this rate to come down. But it is moderating, which is a good sign overall. Inflation, which is the sticky parts of inflation, consumer prices, they've just started to roll over. So that's just starting to come down. We had this straight run up. Now we're starting to come down. I think we could see this accelerate a little bit more to the downside, which would be good. I will be doing a live seminar on the 23rd in San Jose. Haven't been there in a couple of months, so if you want to come and attend, it's absolutely free. Come and meet with us. We'll sit down. I'll show you what I do, how I do it, How do we fit into your program? How do we fit into your financial life? How do we get you to where you want to go financially? We'll show you all of that. Looking at the charts, market has been stuck in this range. 10-year October peaked out at 4.4 and percent for the 10-year note. And from there, we came down, came back up a little bit, came back down to 3.25. That was the low that we made last month. Now we're at about 3.5. 3.52 is where we closed today. Just sitting around. I don't think anything dramatic is happening to rates. We're not going down a lot, not going down up a lot. S&P stuck in this range. This is the high that we made in February, and that was 41.95. Came back up, tested that again last week when we got to 41.88, and today we're at 41.19. So we're stuck in this range right here, 4,200 on the upside, and I'd say around 4,000 on the downside. And that's where we are. This is 39.72. That's the 200-day moving average. This is the 40.47. That's the 50-day moving average. And so, we're just going back and forth, up and down. For the last month, we've been here, 4,200 to 40.47, somewhere around there. I think if we can break out above 42, this is the gap that I pointed out so many times here in August of last year, where we had this tiny gap between 42.18 and 4,200. That's resistance right here. And we get up here and we fall back down. If we can get about 42.18, that'll put us around 42.40, 42.50, and that'll give us a nice move to the upside, and it'll be a breakout. But 4,200 is critical. Why? Looking at the weekly chart, here's another 4,200 number that I'm looking at on the weekly charts. That's resistance. So we've come up, tested it a few times. We need to break out above 4,200. If not, I think we could come back down. We could see the market drop back towards 4,000 or even lower, because we're in May through September, the week seasonal time frame. Plus we've got this budget talks coming in, might have this short-term default, which is just political theater, but it does create anxiety in the market. So that could give us an opportunity to buy some more stuff if we do come down, but that's where we are. Same thing with the Nasdaq, 12,269. We got to 12,265 last week. Still could not break out above it. We need to break above it to go to 12.6. That's the target on the upside right here. Again, same gap right here from the beginning of August, from the middle of August of last year. We need to fill that gap. Again, numbers for my dot plot, as long as we stay above 11.2. Again, we turned up quite a few weeks ago. This was at the beginning of this year. No, a little bit after that. Last few months we've been on the upside, which is good, but we need to accelerate, get above this resistance on the weeklies. If we can, we might even get to about 13,000, but we'll have to wait and see if that happens. Gold market has had a great run, wave 1, wave 2, wave 3, wave 4, and 5. So once we hit 5 waves, what happens? Market pulls back. So it's gone up a lot. Everybody's getting very excited about gold. We had the second highest ever close in gold last Thursday. I think in the short term, we're a little bit overextended. 2017 is this number right here, 20-day moving average, 1968, and then 19 or 1822. But that's way down here. I think I wouldn't be surprised to see about a $100 drop in the gold market. Why gold would go down? I don't know. If inflation comes in stronger than expected, people say, well, that's good for gold. Let's say other people might say, oh, this will push interest rates up. That's bad for gold. So I don't know, but it technically looks like it's a little tired here, and we've gone as high as we can. Pullbacks, I think long-term, gold is on an uptrend, but in the short term, we're a little bit overdone. Those are my thoughts. Again, if you'd like to come to the seminar, May 23rd, I'm in San Jose. If you want to come and have lunch or dinner with me, you can call in, make an appointment. It is free. Looking at the week ahead, I think tomorrow the CPI and the PPI are going to be the driving force for the market. If we get inflation numbers slightly tamer than expected, that would be good. Those are my thoughts. Again, if you need help with your portfolio, all you have to do is go to compak.com, make an appointment, stop by the office right here in Newport. I will be more than happy to sit down with you and develop a plan for you absolutely free. Or you can just dial 800-388-9700. Have a wonderful week. I'm Mo Ansari. I will be back with you. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.